Welcome to the Talking Advisory and Client Solutions podcast. My name is Leah Crowley, and in this series we're taking a look at a range of topics that you might know a little bit about, but want to get a better understanding of. We will discuss a range of topics like buying and selling a business, valuations, due diligence, debt advisory, sustainability, financial transformation, and a whole lot more. In this episode, we've got a couple of wonderful guests. Todd Gammel, partner in advisory at Mann, Judd. How are you?
How you going?
Very well, thank you. And Nick Noonan, partner at Henry William Lawyers. How are you doing?
Good, thank you. Thanks for having us.
Yeah, nice to have you guys in here. And we're talking about something a little bit different, but still in relation to some of the previous episodes. If you've been listening to the series from the very beginning, we'll be talking about HR and considering HR when buying a business, or considerations for HR. How would that sentence be structured, do you reckon, Nick?
Yeah, it's an interesting one, because my experience with employment law is, in a transactional sense, the employees are sometimes parked at the bottom of the priority list, but as a transaction seems to progress, often it's the employee issues that come to the fore.
Yeah, right.
And as we'll talk about today, the way that the deal is structured is relevant to the corresponding HR issues, and purchasers, if we're using purchasers as the focus, can actually do quite a lot pre-transaction and during the transaction to protect their interests. But it's a tricky space because there's a lot of focus on employment law compliance. There's a body known as the Fair Work Ombudsman that has a very big stick that they're prepared to wave in the direction of non-compliant employers. So getting it right early is critical. And isn't it good that that stick's really long as well for all of us? Yes, and I expect that it may even get longer post change of government. Some of the and this is a bit of a segue into some other things that we won't really focus on. But yeah, there's foreshadowing of legislation that will probably look at even criminalising wage theft. So getting this stuff right, more critical than ever going forward.
Now, Todd, what's your main focus within Mann Judd's advisory?
In a lot of the things that we do, I do a lot of the risk management around transactions and certain issues. With HR sort of things, it is a critical part of a lot of transactions, particularly because you need the people for operational continuation, and you also need the people to be comfortable in what they're doing going forward. In some of the transactions we do, or we've worked with clients, you spend 3 months bedding through this process to get the numbers right and get the processes right, and then also try to avoid keeping riskier employees that you might not necessarily want to take forward, and working through a process so that is reasonable and fair, so you don't get hit with the big stick.
Yeah. I have a feeling this big stick's going to come up a few times, which is good. I'm quite impressed with it. So what are the standard types of transactions when buying a business, and why does it matter that you've got that HR employment considerations in there? Who wants to say big stick first?
I promise I won't say it for the next 8 minutes at least.
Okay, all right.
Okay, so in terms of the way in which I get involved and my team gets involved in these transactions, is we are usually working alongside commercial/corporate lawyers that are running the whole transaction. They will loop in people like myself, employment lawyers, property lawyers, litigation lawyers, insolvency lawyers, depending on the nature of the transaction. From the employee perspective, the two main transactions that we deal with are sales of assets, business sales, and sales of shares. They're driven, whether or not it's an asset sale or a share sale, is often driven by tax considerations that Todd can jump in on. But there are enormous implications for employees in the business. So with a sale of business, what's happening is there will be a new employing entity that will buy the assets of an old employing entity, which means, in effect, there's a termination of all of the employees when the business finishes. And we can get into what that means a little bit later. With a share sale, the business will just continue. So employees are employed by a company. Post the transaction completing, there'll be new owners of that company, but the company will stay exactly the same, which means there's no real disturbance at all with respect to the existing employment arrangements. So given that key difference, there's enormous implications for the staff, and particularly if you're looking at it from a purchaser's perspective, they are often preferring a business sale because what it does is quarantine the liability. You've got a completion that happens, all the liabilities live with the old business, and you inherit a new business that you can sort of set up in a way which suits you. With a share sale, you're just inheriting that business, and it may have hairs all over it. So from the employee's perspective, and when you're doing a due diligence process, which would be early on pre-transaction, it's actually more critical because you're basically going to inherit everything that's there, including all of the employees.
The skeletons, everything.
Yeah, skeletons in many closets.
Yeah.
So the DD process becomes even more critical.
Okay, thinking about that, if you're an employee at the business that is looking like it's going to be sold on, you'd be hoping that it's just shares.
It can be an equal sort of transaction either way, depending on what the terms are. Generally, when we work together with somebody like Nick, we will work through the numbers and look at the numbers and understand what is required. Because if a business is getting acquired, it's generally not going to stay the same way. The owners are going to change something, or they're going to integrate it into an existing structure. So there will be generally some roles that may become redundant, so you can move them out, or there will be a different approach to growth. So all of those things play into it, but when you get to a transaction structure, it does come down to purely on risk and sometimes value, because sometimes it is more valuable for a vendor to sell the shares, because there are some opportunities in terms of tax around how you can do that, than a business sale transaction. But it is also around the certainty for the employees. Generally in the timeline, if we're working with somebody like Nick, there will be a transition period where basically if you are doing a business share sale, there will be an offer and a transfer, and everything is bound up and done before you actually do the transaction.
Yeah.
So the employees have clarity.
And the communication is really critical, even though the lawyers and the accountants will say there is actually a fundamental difference between an asset sale and a share sale, and we all know that. From the employee's perspective, they probably don't always appreciate that distinction, but there's less anxiety from the employee's perspective if there's clear communication. So what often happens is once the parties have general agreement about how the transaction is going to be structured, there's communications to the staff. And it might be along... Yeah.
Who is communicating that? Is it the existing owner or is it the new?
Well, it's usually the existing owner, while the existing owner is still the employer of the staff.
Okay, yeah.
So there might be an agreement that's struck at a high level, even when the documentation is still being negotiated, that the purchaser wants to keep everyone. So the existing employer will say, we're negotiating with this company, they may buy the business. They're proposing to keep everyone. We'll be communicating with you. Or if it's an asset sale, they might be saying, soon you'll be receiving a new offer of employment from them, but nothing will change. All your entitlements will be recognised. Completion date set for the 1st of July. No one's stressed, basically. Yeah. So the communication, even though it's not sometimes strictly a legal or a tax requirement, it is really critical, because you want to keep sometimes the value in the business is the staff. Sometimes it's not at all.
Yeah.
Sometimes at the moment when you've got almost full employment, to be able to keep your business going.
Yeah.
I mean, hospitality and retail at the moment are finding it really hard to find people. So if you need to maintain that, you need to keep them there, and you keep them happy.
Correct.
Is it more important to keep the staff or the positions that they fill?
Yeah, good question. And in some respects, there's probably a technical answer to it, but if you take, again, the distinction between the share and the asset sale, if you're a purchaser coming in looking at a business saying, there's 100 employees there, I only need 50 and I want to bring in my own, you'd be pushing for an asset sale, because the effect of that is everyone gets terminated. You can decide who you want to offer employment to. And if the positions are required, but you've got your own ready-made staff, or you've got a labour hire arrangement, that would make that a lot easier. Whereas if it was the share sale and you're buying the whole business, you're either going to ask the vendor to terminate particular people before completion, or once you inherit the business, you've got to do it, which means liability risk.
And that's where your transition period, you can actually sort of a try before you buy a little bit and see whether you can work together with certain people or whether it's not worth it.
And how long would that transition period be?
As short as possible.
2 weeks.
Yeah. Again, like if we go back to legal concepts about the difference, it's sort of, it does bear out what the options are for purchasers. So if we start with an asset sale, because the legal effect of the asset sale is all the existing employees of the business are terminated by operation of law when the transaction happens, purchaser comes in, they can cherry pick who they want to offer employment to, right? They can choose everyone or no one, and they can choose the terms upon which they wish to offer employment. The relevance of that is entitlements and instruments. So with respect to instruments, what that means is there are some specific rules in the legislation that basically say certain instruments will definitely transfer across in an asset sale. So things like enterprise agreements, which is why it's so important to get your due diligence right, because a lot of incoming purchasers might want to have nothing to do with an enterprise agreement. So you need to know that it's there. So those instruments will definitely come across if employees are coming across, which means that there's optionality for the purchaser. They might do the due diligence, look at it, say there's an enterprise agreement there that applies to half of the staff. We don't want that half. Let's just take the management team. We'll only offer employment to the management team. Let's let the vendor terminate everyone else. They can be responsible for all the termination costs. We don't want to inherit them. And then entitlements. So we can come back to that in a bit more detail, but there's options for a purchaser to decide what entitlements they want to take over, leave entitlements. Whereas again, going back to share sale, you're getting everything.
Doing it all.
You're getting everything.
Yeah.
Unless you can do a deal with the vendor that requires them to do certain things like terminate people or enter into new contracts or whatever is required, it's warts and all.
And it often creates a bit of tension on the commercial terms in terms of value as well, because the adjustment can be material.
Yes. Like I've got a transaction at the moment where the value of the employee entitlements is so critical to the total commercial value of the deal. So there's all this back and forth about how much of the employee entitlements will be taken on, because it can affect the purchase price.
Yeah, of course.
And then it makes it uncommercial for the vendor, he says, or he or she says, no, this is all I'm getting. I don't want to do it, but I need that number or I need up here. So
I had a matter recently where we were acting for the purchasers and the business was in administration. And that's not uncommon. You know, you've got a purchaser that comes in, looks like a good business, just needs a bit of life pumped into it. We made it very clear that we didn't want to take on entitlements. We wanted to start people fresh, and you have that option if it's an asset sale. And I don't think the consequence of that was fully appreciated by the vendor. They didn't realise that by doing that, they were bound to pay
crystallising all of those liabilities.
Notice and redundancy, and I don't think they'd factored that into their calculations. So suddenly, when the deal's ready to be signed off, that became a critical issue because we had to get on the same page about what that meant for the parties, and it affected the whole commerciality of the transaction.
And I don't know how many disputes I've had on larger transactions, smaller transactions, all transactions around what the actual calculation of the entitlement adjustment, because generally it's an adjustment in the sale.
Yes.
And everybody goes, oh, but accounting-wise, this is what it is.
Yes.
Yeah, but that's not what the contract says.
Right, yeah. So I guess what that means is when you are the purchaser that's taking on employees in an asset sale, you have options about what you want to take on, and I'll come back to those options in a second. But if you take on all the employees and all the entitlements, all of a sudden you're the purchaser running the business with X dollars of annual leave, long service leave, sick leave, parental leave. What is customary?
Workers' comp on top.
Workers' comp, all these other on costs. So what is customary is the purchaser says, well, if I'm taking on $1 million worth of entitlements, I want $1 million deduction to the purchase price. And the accountants will say, oh, it should be 70%, not.
But I've seen it add on workers' comp on top, add payroll tax on top.
There's no rules to this stuff, right? That's all part of the negotiation. But I think there's a there's a tax
you
answer that's
discount
accurate.
and that's basically because, and it is a fairly standard adjustment, because you're only taking on the entitlements that you are going to actually have to pay. The rest of it is tax that you'll pay as sort of a wage thing. So you don't get that benefit. So when you say 70% means the tax deduction you will get for paying those entitlements in the future is 30%, or the normal deduction. So that's why that's but people still look at it.
Yeah.
People look at it and go, why do I only get 70%? I've got to pay the whole amount.
That's right, yeah. So 70% is the standard because there is a tax deduction, and it all makes sense. But I've been involved in matters where there's no adjustment because the business is in administration and the purchaser says, we'll just take it on. We don't need an adjustment because it's otherwise a good deal. Or conversely, other matters where it's not 70%, you're getting the full 100%. And you've got clients that are able to throw in not just the annual and the long service, but they'll say, throw in all the sick leave as well. We want an adjustment for that. And it gets across the line.
There's so much to consider, isn't there, in a business sale or business purchase, I should say. In that respect, are there any other particular considerations that a purchaser should take into account when reviewing transaction documents like a business sale agreement?
Do you want to go legal and all?
Yeah, well, absolutely. So again, starting with difference in the transaction, I think we've made that clear. But again, whether it's asset or share, you're going to inherit employees, so you want to know what you're inheriting. So doing the due diligence, you want all the existing details about all the existing employees.
So how into the nitty gritty are you talking for details?
Well, it depends on the size of the transaction. Sometimes the client will say, hey, this is only worth $1 million. We don't want to spend $100,000 on legal, so it's a short form DD. But as the transactions increase in size, the DD becomes more onerous.
And it depends on how well the records are maintained.
Yeah.
If there's consistency in the contractual arrangements, you can do a higher level review and say all the contracts are the same. Terms are very same. Enterprise agreement is relatively consistent, and you can apply that regime. But if you've got something which has been grown out of a garage all the way up to
no records, no contracts.
It's done on the smell of an early rag, and things have just happened because they've happened. That can be more difficult because there can be some sneaky liability sitting in there that you can't identify unless you do that deep dive.
And that's why sometimes the way the transaction's structured is not agreed until the due diligence is done. Because if you do the DD and you realise there's liabilities everywhere, no one's got an employment contract, no one owns the IP, you've got someone that's been there 1,000 years and they're owed lots and lots of money.
You price the risk.
Yeah, the purchaser might say, we should actually buy the business. The vendor can get rid of everyone. We'll bring in our own people. But as far as, contractually what you can do, I think one of the key advantages of the existing legislative regime with business sale agreements is the purchaser can actually cherry pick what they want to take over.
Yeah.
So there's some things that you cannot contract out of. So, for example, sick leave and parental leave.
They're legal responsibilities.
They're legal responsibilities, and they will definitely come across. But there is options about things like annual leave, redundancy pay, unfair dismissal, which I'll come back to because it's really important. But what can happen is the purchaser can say, I want to take on all these people, but I'm not taking on their annual leave entitlements. So
what
the
does
vendor,
that mean?
well, it means someone's got to pay for it, right? Along the line. You can't just extinguish the entitlement. The vendor's got to pay for it. Or redundancy is the other one. Vendor can do redundancy.
I've seen it where they've split 50-50. We'll take 50% of the annual leave, and everybody has to agree. You've got to get the employee to agree to that as well, I would expect.
And the other big one is unfair dismissal. So as a purchaser, you can take on staff, you can take on all their entitlements. So they're coming across basically clean. However, you can impose new probationary periods, which is the try before you buy that Todd mentioned earlier.
Yeah, right.
Which I think from a policy perspective is a bit unfair.
It's a bit cheeky.
It's a bit cheeky, and it's not going to be perceived very well by the employees.
No, I've been, if I've been there 10 years, I've been in this role for 5.
That's right.
I know it better than you do. So what are you doing a probation? Yeah.
But the legislation enables you to do it, which means you could have someone that's been there for 10 years.
Yep.
You terminate them within the first 6 months, they've got no unfair dismissal rights. Whether or not
It's a vagary of the law.
Yeah, whether or not that provision will continue indefinitely remains to be seen. But certainly I've had clients that have imposed that in circumstances where they've otherwise taken on all the other liabilities.
And look, I think one of the other things in this sort of area where you're doing DD with underpayments is an issue that's arising. And we understand commercially to get your insurance on your warranties, you need to have reviewed your underpayments if the employee entitlements are above a certain level. And underpayments is an issue for ASX 100 companies. So it's got to be an issue all the way down if they can't get it right.
Is this where the big stick gets mentioned?
Yeah, it's been about 8 minutes.
We've held off.
Yeah.
We'll check the timer. Underpayments is a big one. And it's a big one partly because our IR system is so complex, like unnecessarily so. So complex. Like we have 120 something, don't quote me, awards, which are industrial instruments that set minimum terms for different occupations and industries. So they cover probably the majority of Australia's workforce.
And then you've got state legislation as well.
State legislation, long service leave, workers' comp, work health and safety. But these awards are so complex and they're filled with minimum obligations like penalties and overtime, allowances, breaks. It's really, really hard, even if you're a good employer, in inverted commas, to strictly comply. Yeah. Which means you're inheriting employees, take a share sale where it's really hard to confirm whether the vendor has done the right thing, paid everyone their entitlements. So I guess contractually you can build in protections around, indemnities and warranties, the vendor's promising that they've paid everyone correctly, but really, really hard until you're running the business to actually get that right.
Including historical super things as well.
Yeah.
Of course, yeah.
Because historical super, you could become, if you're doing a share sale, you could become personally liable for that amount if you haven't been paying it properly.
Yes.
And if you look at it, wage underpayments, a lot of it in the larger businesses is just being calculation errors, minor calculations. Like we're talking from the stop point, we're talking 4th digit, 5th digit, but because of the volume of employees and the period, it's a big number. And
yeah, you've got some high profile businesses that are being prosecuted at the moment, and that's been the case. That's been the trend for 5 years or so. And a lot of those businesses are, I've got no doubt, filled with lawyers that have reviewed these things. And what's commonly happening with those businesses is they've got relatively senior people on enterprise agreements and modern awards, and instead of paying them hourly rates plus overtime and allowances, they're just paying them an annual salary. And they're setting that salary and forgetting about it, and they're never doing a reconciliation. And this is the stuff now that the legislation expects you to do. If you're paying someone an annual salary, check it against the underlying entitlements, reconcile it, make sure that if there's a shortfall, pay the people.
How often?
Well, it depends on the award, but the awards now have provisions in them, not all of them, but provisions in them that, for example, enable you to pay someone an annual salary as long as you do a 6-month or a 12-month reconciliation.
Okay.
But a lot of businesses are not using those provisions. They're just doing contractual annual salary provisions and they're never checking. They're not keeping the records that they need to keep, which is another sort of transfer of business requirement. You're meant to inherit all the employee records, and they are meant to include things like overtime hours. But a lot of good businesses, compliant businesses, I've got no doubt, are not doing this, and they're getting away with it because they're probably not underpaying their staff.
Yeah, right.
But all it takes is one person to say, I've kept all my own records of my overtime and try and prove that I'm wrong, for there to be potentially a big investigation over the whole business.
And that also adds complexity when you're doing your employee entitlements calculations.
Yeah, correct.
Because generally there's a number of ways you can do it, but it's based on this average hourly rate for the past 12 months for certain people. How you calculate that is got to include allowances and all sorts of other different things, and overtime and what else, to sort of get this meshed rate. And then you calculate the entitlements on that. It's not a simple, this is what you get as your
exact science.
Yeah, so there's a lot of calculation complexity in all of these things that can quite easily go wrong.
Yeah, it definitely sounds like there's room for errors that have never been checked or have never been found until you do the due diligence.
Yeah, correct.
And
so even I would imagine the vendor's like, oh no, how did this
You can
get
see
so
why.
far.
You can see why the employment lawyers in particular are usually
Make a lot of money.
Not only that, but are usually pushing for business asset sales instead of share sales, because it enables you to start from scratch, quarantine the risk, let's get it right. Let's cherry pick who we want, use our contracts. Let's check that we're paying these people accordingly, because it just mitigates the risk significantly.
Well, I mean, you guys were talking about the fact that there's all these different awards. So there'd be all these different awards within, depending on, the size of the business or the company, but they'd have all different awards. But then you'd also have different states with different...
Yes.
Oh.
Yeah, it's not uncommon. Like, I've got clients that will have 4 or 5 awards across the business.
Yeah.
Again, overly complex in Australia. Hopefully someone's listening. We have the most overly regulated, overly complex IR system probably in the world.
And then you can have an enterprise agreement for each individual site or
different
each
parts
individual
of the business. And sometimes it's missed, and you'll inherit it in a sale of business, and all of a sudden you're stuck with this enterprise agreement that you don't want, and you've got to go up to the Fair Work Commission and try and get it extinguished.
And you look at, there is an emerging industry. In the paper a couple of weeks ago was Yellow Canary raising $11 million to expand, and they're putting on 4 or 5 people per week, because their business doing the wage reviews and then coming up with an annual process is just expanding so quickly.
Yeah, we actually work with businesses like that, where they've got sort of the data analytics power to get all of the data. And this is not only in a transaction sense, but sometimes just for clients to do an audit to make sure that they're paying people correctly because it's so complex. Yeah. Get all the data, review it, feed in the awards, and identify where there are shortfalls. Yeah. Because most payroll systems that are on the market don't do that, or don't do it well. They're all trying to start.
Or you end up with an Excel spreadsheet the size of the wall, and who knows whether it's accurate or not.
Or someone with a pencil, in a small room. It's very difficult to be compliant. That's the point. Like even organisations that spend lots on lawyers, it's very difficult to be compliant.
And then you got simple things like changes in superannuation rates. Yeah. That have an impact and don't necessarily go through on time. And then the government's now going to put through 5%. They've promised to put 5% change increase. So that's going to have a flow-up effect all the way through.
Yes.
We won't even talk about inflation.
No. And even the classifications in the awards, you get this sort of slippage. So if you've got an award-related person, you're meant to classify them under that award, because the relevance of the classification is it sets the minimum rate of pay. So if you start someone on a level 1, you can't just set and forget, because in a couple of years' time, they're probably a level 3 entitled to a few more bucks. Yeah. But it's easy to miss unless you've got someone dedicated to doing this.
And then you've got the interaction of the role specifications for each individual in each company, and how that meshes against the award, and whether there's extra in there or less or whatever else. And
the fact that people have to, organised businesses have to engage lawyers to identify the award that applies to their business and the classifications that apply to their employees is pretty crazy.
It's an indication.
Keeps me in a job. Yeah. It's pretty crazy, to be honest.
So we're talking about all of this and how complex it is, and we're talking about asset versus share. When there is a big company where there's lots of employees, are you finding that it is the asset route that people are going down?
In what I do, we do obviously some distress. So we do some restructuring and recapitalisation of entities. Even in a recapitalisation, there generally will be some consideration of a business sale, and it may well be to move some of the risk out. So you may have multiple sort of transactions happening, rather than just doing a share recapitalisation and just taking the thing on warts and all. But it depends on the value. If there is an inherent value to the purchaser which outweighs all the risks, they'll take it on. But they will also then, if that's the position, generally they'll spend the money on DD to be able to get things done properly, so that they can minimise the risk. They'll be wanting warranties, they'll be wanting insurance, they'll be making all of that, doing all of the logical things. If it becomes too cumbersome, it does transition over to an asset share sale. Okay. We've done it on a couple of larger matters with 400 or 500 employees who were getting paid good money. It took 3 months to be able to work through the process, because we took it on the basis that we would agree individually with each of them what their entitlements are, then confirm that with the purchaser, how they wanted to transition it, and they wanted to maintain as much of the workforce as they wanted to, but they didn't need everybody. So they looked at it on a very balanced way and said, well, these are the people who don't fit our model going forward. So
it's a typical lawyer or accountant response. It depends on the circumstances, but every transaction's different. Like I don't think you could say that I see one over the other depending on one particular factor. Like there's tax considerations, there's key contract considerations, there's liabilities. Every transaction is looked at.
And it looks at also the costs of actually transition.
Yeah.
So if you've got, say you have a large retail business and there's 150 retail leases sitting in an entity. Nick's not a lease lawyer, so I can say this. Lease lawyers sit down and rub their hands together because
they're doing assignments for 50 leases.
Yeah. That's $500,000 before you turn around.
Wow.
Well, that's how people have a practice. But so in that scenario, you go, okay, is there a smarter way? What's the risk? What's the cost? And you put it all together. And also the retail employee position, maybe there's more casual, so that sort of reduces your risk. You can look at all of those. All of those factors come into it, and then over the top is the actual outcome for the vendor.
Yeah.
Whether this is tax effective, whether it fits in a fund, or whether it's an individual, or all of those sort of things playing through. And then overarching all of that is timing pressure.
Correct, yeah.
Because everybody wants it all done. Like, come on, let's get it.
Yeah, usually
and competition. That's the other factor, because if it's a good business, somebody might have to do a little bit better deal than somebody else to get the deal.
The parties usually have in mind what it's worth, and I guess the lawyers and the accountants nut out how to
the adjustments
maximise that value and structure the transaction around it. But things like leases, as an example, key contract, employees, they're all the different factors that inform whether or not the transaction is a good idea, for one, but secondly, how to structure it.
Yeah. Is there anything else that you want to throw out there and sort of shed light on?
I think the big thing is that no matter what you're thinking about, is the best thing is to go and get somebody just to give you a feel, first of all, about the issues you need to think about. Even if it's only $100,000 transaction, there are ways straight away to minimise your risk. Don't be shy to ask questions, and there's no silly questions in this, because it is a very logical process to do the DD to be able to eliminate all these risks. It can just be long.
And more broadly, it's not specific to transactions. Because it's so complex and highly regulated, and it changes all the time, and it's about to change again post-governmental change, when I sit down with any new client, they'll often want you to do something in particular. The first thing I usually do is say, we need to understand your business and the employment sort of parameters of your business. So give me a list of your staff. What do they do? What are you paying them? How are you paying them? What do your contracts look like? Because sometimes lawyers can just jump into doing something, and there's all that fundamental information that needs to first be assessed, because sometimes they've got it wrong from the outset. Like you've got the award wrong, or you don't know that there's an award. Your contracts have provisions in there that are terrible that are going to bite you at some future stage. So, getting some advice early on about whether you're engaging your employees in a compliant fashion is worth it, because even small businesses don't have many opportunities to argue that they're ignorant to the law. Like there are some small business concessions, but really small businesses are largely treated the same way as any other business. You're expected to be compliant, and it's difficult to be compliant.
And I think it's a little bit different in terms of looking at it from a potential seller and a vendor position. But if you are going to be a potential vendor, and even if you are buying to become a potential vendor in the future, you need to get all this right, because it will make the process of sale easier,
correct,
more cost effective, and you'll probably recover the value that you're investing.
Yeah, it's a really good point. If you're compliant, you're an attractive proposition for a purchaser, and it makes the whole transaction run more smoothly.
Yeah, I bet. I reckon this is the kind of episode that you want to have a listen to at least twice, just to get your head around some stuff.
I'm going to take that as a compliment.
Yeah, no, definitely. There's a lot in here. There's a lot in
Maybe
here.
I shouldn't.
No, it's good. Todd and Nick, thank you so much for coming on and shedding some light. If people want to get in contact with you, Todd, is it just the hlb.com.au?
Yeah,
easiest
on the website.
way?
Yep.
Fantastic. And what about you, Nick?
Henry William Lawyers website.
Perfect.
It's easy. Thank you. Thanks for
Very
the opportunity.
easy. Thanks, guys.
Thank you. That was
Thank
great.
you.
This topic is part of HLB Mann Judd's Advisory and Client Solution Services. For more information, please visit our website hlb.com.au.